Have you ever watched the market take a nosedive with that sick feeling in your stomach as everything turns red and wondered how some people just seem unbothered? It's a feeling of helplessness most investors know all too well. You watch your hard earned money, the result of years of disciplined work, seem to evaporate in a matter of days or even hours. The news is a fire hose of negativity. So called experts are predicting the next big crash, and your gut is screaming to just sell everything and run. And yet, in the middle of all that chaos, there's a group of investors who seem to be playing a completely different game. The wealthiest, most experienced players in the market, the smart money, don't just get through these downturns. They often come out the other side even stronger. They're not panicking. They're not glued to the financial news with a sense of dread. So, what's their secret? It's not a crystal ball. They can't predict the future any better than you or me. The secret is that they aren't playing the same game as everyone else. While the average investor is focused entirely on offense, trying to pick the stocks that will shoot to the moon, the smart money spends just as much time, if not more, on defense. They are masters at protecting what they already have. They see risk not as something to run from, but as something to be managed, controlled, and even neutralized. Today, we're going to peek inside their playbook. We're going to explore the powerful techniques these investors use to shield their fortunes, lock in profits, and sleep soundly at night, no matter what the market is doing. This isn't about timing the market, it's about building a financial fortress. The key to this whole philosophy is something we can all understand: car insurance. Think about it. You pay that premium every single month. Why? You don't pay it because you expect to get into a crash. If you did, you wouldn't leave the driveway. You pay it because you know a crash is possible. It's a worst case scenario you hope never happens, but you want to be prepared if it does. That small regular payment buys you peace of mind, ensuring you're protected from financial ruin. You don't get the premium back at the end of the year if you have a clean record, and you don't feel bad about it. You understand it was the cost of protection. This is exactly how smart investors think about their portfolios. They see a market crash as a potential financial car wreck, and so they willingly pay a small premium to ensure their wealth against that disaster. This strategy is called hedging. Hedging at its core is just a risk management strategy. It's about taking a second position in something that's designed to go up in value when your main portfolio is going down. It's the art of financial self defense. So, how do they actually create this financial insurance? They use a specific set of tools. Some are surprisingly accessible, while others are pretty much exclusive to global corporations and billionaires. We're going to break down three of the most powerful methods they use, starting with personal portfolio protection and working our way up to the secrets of corporate finance. The first and most direct form of portfolio insurance is a tool that sounds complex, but is actually pretty simple in concept: the stock option. Specifically, we're talking about a put option. Buying a put option is the closest you can get to buying an actual insurance policy on your stocks. So, what on earth is an option? Let's break it down. Imagine you want to buy a house listed for $500,000. You're not ready to buy today, but you want to lock in that price for the next 3 months no matter what. You could go to the seller and say, I'll give you $5,000 today for the right, but not the obligation, to buy your house for $500,000 anytime in the next 3 months. If they agree, you've just bought an option. That $5,000 is your premium. The $500,000 is the strike price. And the 3 month window is the expiration date. Now, one of two things can happen. If the housing market booms and the house is suddenly worth $600,000, your option is golden. You have the right to buy it for $100,000 below market value. But if the market slumps and the house is now worth only $400,000, you'd just walk away. Why buy it for $500,000? All you've lost is the $5,000 premium you paid. You were protected from a huge loss. A stock option works the exact same way. There are two basic types: call options, which give you the right to buy a stock, like our house example, and put options, which give you the right to sell a stock at a certain price. For hedging, we care about put options. Let's walk through it. Imagine you own 100 shares of a company, Innovate Corp, currently trading at $150 per share. Your investment is worth $15,000. You like the company long term, but you're nervous about the next few months. You think the market might take a hit and you want to protect that $15,000. This is where you buy a protective put. You go to the options market and buy one put option contract for Innovate Corp. One contract usually covers 100 shares. You pick a strike price of $140 and an expiration date 3 months from now. The cost or premium might be $5 per share. So, for a total of $500, you've just bought yourself an insurance policy. What did you just do? You guaranteed that for the next 3 months, you can sell your 100 shares for at least $140 each, no matter how low the price actually goes. You've just created a safety net for your investment. Let's play out two scenarios. Scenario one, the hedge works perfectly. A week later, bad news hits and panic selling starts. Innovate Corp plummets from $150 to $100 a share. Your $15,000 position is now worth only $10,000. You're looking at a $5,000 paper loss. This is where most people panic, but you have your put option. It gives you the right to sell your shares for $140. Even though they're only trading at $100, that right is now extremely valuable. The option itself will be worth at least $40 per share. The difference between the strike price, $140, and the stock price, $100. Your one contract is now worth at least $4,000. Look at your total position. Your stock is worth $10,000, but your put option has gained thousands in value, offsetting most of the loss. You can either sell the valuable option for a profit or exercise your right and sell the shares for $14,000. Instead of a catastrophic $5,000 loss, you've limited the damage. Your insurance paid off. Scenario two, the cost of insurance. Now, let's imagine the opposite happens. Your fears were overblown, the market keeps climbing, and 3 months later, Innovate Corp is up to $180 per share. Your 100 shares are now worth $18,000, a nice $3,000 gain. What about your put option? The right to sell a stock for $140 when it's trading at $180 is worthless. So the option expires and you're out the $500 premium you paid. Did you lose money? Not really. You paid a fixed cost for protection you didn't end up needing. Just like car insurance, your net gain is still $2,500, the $3,000 stock gain minus the $500 option cost. You still got to enjoy the upside, but you had a safety net the whole time. This is the trade off smart investors are happy to make. They'll gladly sacrifice a small piece of their potential gains to eliminate the risk of a huge loss. Now, you might be thinking, that's great for one stock, but I own 20 of them. Buying puts on everything would be a nightmare. And you're right. That's why sophisticated investors usually don't do that. Instead, they hedge their entire portfolio by buying put options on a broad market index ETF, like the SPY, which tracks the S&P 500, or the QQQ, which tracks the Nasdaq 100. If you own a portfolio of large US stocks, it's probably going to move in the same general direction as the S&P 500. So by buying puts on SPY, you're basically buying an insurance policy on the entire market. If the market crashes, your portfolio will go down, but the value of your SPY puts will shoot up, offsetting a big chunk of those losses. Of course, this strategy isn't perfect. Hedging costs money. Those option premiums will eat into your returns over time if the market just keeps going up. It's a guaranteed small loss for the chance to prevent a huge one. Plus, picking the right strike price and expiration date is a skill in itself. This is why it's considered a professional strategy, but the principle is what's key, paying a small defined cost to prevent an unknown, potentially devastating one. Our first strategy was about directly insuring your stocks. This next one is a little different, more indirect. It's about understanding market psychology and finding a way to profit from the one thing that's always there during a crash: fear. When markets fall, it's not just numbers on a screen, it's an emotional event. Uncertainty spikes, panic spreads, and that collective anxiety becomes a real force in the market. There's actually an index that measures this: the CBOE Volatility Index, better known by its ticker, the VIX. On Wall Street, everyone just calls it the Fear Index. The VIX doesn't measure stock prices. It measures the expected volatility of the S&P 500 over the next 30 days. Basically, it's a gauge of how much chaos the market is bracing for. When things are calm and the market is slowly climbing, the VIX is low, maybe in the 12 to 18 range. But when a crisis hits and the market starts to plunge, the VIX explodes. It can spike to 30, 40, 50, or even above 80, like it did during the 2008 financial crisis and the 2020 COVID crash. Here's the key insight: the VIX and the stock market are negatively correlated. When the S&P 500 goes down, the VIX almost always goes up. So, smart investors ask themselves, if I know fear will spike during a crash, can I invest in fear itself? And the answer is yes. One way is to buy call options on the VIX. Remember, a call option gives you the right to buy something at a set price. By buying a VIX call option, you're betting that volatility, that fear, is about to go up. Let's say the VIX is sitting at a calm 15. A hedge fund manager might buy a bunch of VIX call options with a strike price of 20. Those options would be cheap. But if a market shock hits and the S&P 500 drops 10%, the VIX might surge to 35. Suddenly, the right to buy at 20 is incredibly valuable. The profits from those VIX calls can be huge, helping to offset the losses in their main stock portfolio. They literally profit from the panic. But let's be clear, trading VIX options is incredibly complex and risky. These are not buy and hold investments. They have structural issues that cause them to lose value over time if volatility doesn't spike. This is a tool for pros. For everyone else, there's a simpler, though still risky, alternative. That alternative is the inverse ETF. You're probably familiar with a standard ETF like SPY, which goes up when the S&P 500 goes up. An inverse ETF is designed to do the exact opposite. It's built to go up in value when its underlying index goes down. For example, the ProShares Short S&P 500 ETF, ticker SH. If the S&P 500 falls by 1% on a given day, SH is designed to rise by about 1%. If you're worried about a short-term market dip, you could put some money into SH. If the market falls as you expected, the gains in SH will help cushion the losses in the rest of your portfolio. Sounds like the perfect hedge, right? It's simple and easy to buy, but there is a massive catch you have to understand. Inverse ETFs are designed for daily performance. Their goal is to give you the inverse of an index's return for a single day. Over longer periods, the math gets really weird because of daily compounding. Imagine a choppy market. Day 1, the S&P 500 drops 10%. Your inverse ETF, SH, goes up 10%. Great. Day 2, the market rallies 11%. Over 2 days, the S&P 500 is roughly back where it started. But your inverse ETF, it went up 10% and then down 11%. It's now lower than where it started. In a choppy sideways market, both the index and the inverse ETF can lose money. Because of this, inverse exchange traded funds are not long-term investments. They are short-term tactical tools for hedging against a specific anticipated risk. Then you have the even more dangerous versions, leveraged inverse ETFs like SDS, which aims for negative 2 times the S&P 500's daily return, or SPXU, negative 3 times. These are pure rocket fuel and should be avoided by the vast majority of investors. The main takeaway here is the principle. Identify a side effect of a market crash, like a spike in fear, and find something that profits from it. For the pros, it's VIX options. For a more accessible, but very cautious approach, it might be a small, tactical position in a regular inverse ETF. We've just covered some seriously powerful techniques for protecting your money, from using put options as direct insurance to using inverse ETFs to profit from fear. These are the kinds of strategies that separate amateurs from pros. If you're finding this valuable and want to learn more about how to invest like a professional, go ahead and hit that subscribe button. We're all about showing you how smart money really works, and you won't want to miss what's next. Now, let's leave the world of tools for individual investors and step into the world of multinational corporations and hedge fund titans. The scale is bigger, the risks are more complex, and the tools they use are far more powerful. We're going to talk about a concept that's fundamental to high-level finance, but rarely discussed outside of it: swaps. To understand why a tool like this is necessary, think about the risks a huge global company faces. Let's take a giant American tech company. They design their products in California, have them built in China, and sell them all over Europe. This company is tangled in a global web of financial risks. Let's focus on their European sales. They sell millions of products in Germany, France, and Italy, and they get paid in euros. But they're an American company that has to report its earnings to Wall Street in US dollars. This creates a huge problem: currency risk. Let's say they have a great quarter and bring in 1 billion euros in sales. At the start of the quarter, the exchange rate was 1 euro to $1.10. So they're expecting that 1 billion euros to become $1.1 billion in revenue. But what if, over the quarter, the euro weakens against the dollar and the rate falls to 1 euro to $1.02? Suddenly, their 1 billion euros in sales is only worth $1.02 billion. They've just lost $80 million in revenue. Not because they sold less, not because their business was bad, but simply because the foreign exchange market moved against them. For a company's CFO, this is a nightmare. It makes planning almost impossible. They need a way to get rid of this risk. This is where a currency swap comes in. A currency swap is basically a private contract between two large institutions to exchange cash flows in different currencies. It's not something you can buy on an exchange. It's a private deal, usually set up by a big bank. Here's a simplified version of how it works. Our American company has a euro problem. At the same time, maybe there's a big German car company that sells a lot of cars in the US and is sitting on a pile of US dollars. They have the opposite problem. They're worried the dollar will weaken before they can convert it back to euros. These two companies, through a bank, can enter a currency swap. The American company might agree to give the German company its 1 billion euros. In return, the German company gives the American company the equivalent in US dollars, say $1.1 billion, based on the rate that day. At the end of the contract, maybe 5 years later, they agree to swap the exact same principal amounts back at the exact same exchange rate they started with. What did this do? It completely eliminated the American company's currency risk. They knew from day one exactly how many US dollars they would get for their euros. The chaos of the currency market became irrelevant. They used a sophisticated tool to hedge to neutralize a specific risk. This is a cornerstone of modern global trade. The same swap idea is used for other big risks, like with an interest rate swap. Imagine a developer takes out a $500 million variable rate loan to build a skyscraper. If interest rates spike, their loan payments could balloon and bankrupt the project. To hedge this, they can enter a swap with a bank. The developer agrees to pay the bank a fixed, predictable interest rate. In return, the bank agrees to pay the developer's unpredictable variable rate to the original lender. The risk is gone. Now, it's critical to understand that you can't just call your broker and ask for a currency swap. These are wholesale products for institutions dealing in hundreds of millions or billions of dollars. So, why are we even talking about them? Because the thinking behind the swap is the ultimate lesson. It's the purest form of hedging. The thought process is isolate a specific risk, not a vague fear, but a precise one. My revenues from Europe will be worth less if the dollar gets stronger. Quantify it. How much money is actually at risk? Find a tool to neutralize it. Don't just guess. Find an instrument designed to offset that exact exposure. Execute the hedge and move on. Once the risk is neutralized, you can focus on your actual business or investment strategy. While you may not use a currency swap, you can apply this exact same thinking. Have a lot of tech stocks? Your specific risk is a tech downturn. You can hedge that with puts on the QQQ. Own a lot of international stocks? Your specific risk is a stronger US dollar. You can hedge that with currency hedged ETFs, which use a simpler version of swaps to remove that exact risk. The secret of the billionaire's hedge isn't the complex tool, it's the disciplined surgical mindset of identifying and neutralizing risk. So, what did we learn today? We've looked at three levels of how the smart money protects their fortunes. First, we explored the protective put option, the most direct form of portfolio insurance. By paying a small premium, investors can create a hard floor for their investments, guaranteeing they can sell at a predetermined price no matter how far the market falls. Second, we looked at profiting from fear. We saw how pros use instruments tied to the VIX to turn market panic into a source of profit. We also looked at the simpler but tricky alternative of inverse ETFs, which act as a direct counterweight to a falling portfolio. And finally, we peeked into the exclusive world of swaps. While out of reach for most of us, the principle of surgically identifying and neutralizing a specific risk, whether from currencies or interest rates, is the ultimate lesson in professional hedging. The common thread here is a fundamental shift in mindset. Most investors only think about offense, how much they can make. But the pros, the ones who build and keep wealth for generations, are just as obsessed with defense. They treat hedging not as a bet against the market, but as a non negotiable cost of doing business. Just like insuring a house or a car, protecting your money isn't about being pessimistic. It's about being a strategist. It's about replacing emotion with a plan. It's about building a resilient portfolio that can weather any storm and give you what every investor really wants: peace of mind. Thank you for joining me. If you found these strategies insightful, please give this video a like and subscribe for more content that breaks down the world of professional finance. I have a question for you. Which of these hedging techniques did you find most interesting? Let me know in the comments below. I look forward to reading your thoughts.